Do you ever have a feeling like something big is coming? Like the world is about to change in a way you can't even begin to imagine? The economy is on unsteady ground, and it's time to take action. Get your money out of the bank now and take control of your financial future. Don't be a victim of this unpredictable economic climate. Secure what's yours before it's too late. It is possible that the collapse of Silicon Valley Bank would have a devastating effect on the most cutting-edge sector of the U.S. economy, halting payments to tech employees and triggering a chain reaction of failures at other regional banks. Furthermore, many experts believe it will set off a domino effect of financial collapse. So what triggered the Silicon Valley Bank collapse? What does it mean for the banking industry? Is a possible banking crisis around the corner? And why should you get your money out of the bank immediately? Stay with us till the end to find out. After a shocking 48 hours, during which Silicon Valley Bank's capital problem sparked concerns of a catastrophe throughout the financial sector, the bank went bankrupt on 10 March. Its demise is the most significant in the United States since the 2008 collapse of Washington Mutual, which occurred at the height of the financial crisis. Officials in California shut down the bank and turned it over to the U.S. Federal Deposit Insurance Corporation. The FDIC is the receiver. Thus, it will likely sell off the bank's assets to reimburse the bank's owed depositors and creditors. What does this mean for the banking industry? And why should you get your money out of the bank? With $209 billion in assets as of December 31, 2017, Silicon Valley Bank was one of the top 20 U.S. commercial banks. Nevertheless, Silicon Valley Bank largely served high-risk technology businesses, which have been hit hard by rising interest rates and falling venture capital funding in recent years. Even though the bank was working with over half of all U.S. venture-backed tech and healthcare startups, many of these companies ended up moving their deposits elsewhere. As Silicon Valley Bank stock dropped over 60% in pre-market trading on March 10. Trading was suspended. Shares dropped 60% on March 9 after the bank said it had to sell $1.75 billion in shares and a portfolio of U.S. Treasuries at a loss to offset rapidly dwindling client deposits. Several other bank stocks, like those of First Republic, PacWest Bancorp, and Signature Bank, were also halted on March 10. On 9 March, as a result of the problem at Silicon Valley Bank, bank stocks throughout the globe dropped, sparking worries of a global financial disaster. William Ackman, manager of the hedge fund Pershing Square Capital Management, likened the situation at Silicon Valley Bank to the closing days of Bear Stearns, the first bank to fail at the outset of the global financial crisis in 2007 to 2008. Ackman warned in a series of tweets about the potential for collapse and deposit losses if the next, least well-capitalized bank faces a run and falls, and the domino effect continues. Wall Street was shaken by Silicon Valley Bank's sudden demise, the second-largest bank collapse in U.S. history after Washington Mutual in 2008. The stock prices of the 5 main competitors in the business, J.P. Morgan Chase, Bank of America, Citigroup, Wells Fargo, and Goldman Sachs, dropped significantly in Silicon Valley Bank's closing days. Throughout the last 5 trading days, Bank of America lost roughly 12% of its value. Financial institutions like Silicon Valley Bank and Silvergate Capital, a San Diego-based bank that specialized in Bitcoin users that serviced high-risk sectors of the economy, are now in the red. Last week, Silvergate stated it will voluntarily close its doors because of the flight of customers caused by the recent decline in the value of cryptocurrencies. For startups, the worry was whether or not they would have enough money to pay their employees the next week when their money was frozen at the failing bank. Authorities hurried to investigate the oversight. Roku, a California vineyard, and humanitarian endeavors supported by venture investors, such as clinical studies for potential medical cures, all experienced a sudden lack of financing. Potentially devastating effects on the economy and society as a whole might result. People could find themselves in trouble out of the blue. Some similar institutions are starting to lose investors. After taking a financial hit from the volatility in digital assets, Silvergate, a lender that specializes in cryptocurrencies, said on 8 March that it is closing its doors and liquidating its holdings. New York-based commercial bank Signature Bank stock dropped 23% after trading was suspended earlier in the day due to the firm's substantial exposure to the cryptocurrency business. According to Alt's calculations, by the year 2022, interest rate hikes will have essentially wiped away nearly 28% of all the capital in the banking system. Banks bought large quantities of low-risk treasuries with extended maturities while interest rates were very low. Yet the value of those assets has dropped as the Fed has raised interest rates to combat inflation, leaving banks with unrealized losses. Higher rates are causing widespread adjustments to financial models. Since the end of 2021, the average 30-year mortgage rate has more than doubled to 6.7%, making it unaffordable for many would-be homeowners. In 2025, the U.S. government will likely spend over $300 billion more in interest on the national debt than it did in 2022. And banks like Silicon Valley Bank, which grew along with their customers who were willing to take risks when rates were close to zero, found themselves in unknown territory. The question is, what triggered the collapse of Silicon Valley Bank? What did they do wrong? Silicon Valley Bank was heavily dependent on a single risky sector of the economy for both its depositors and its customers. That centralized wager ended up being terrible news for the risk-taking newcomers who run the show in the high-tech industry. After more than a decade of essentially interest-free borrowing, the recent shift has been as dramatic as an instantaneous temperature drop. Several investments that seemed like solid bets while rates were low are now major losses because of the changing conditions. In 2021, Silicon Valley Bank had a surge in deposits, which the bank mostly put into long-term government bonds. Banks like Silicon Valley Bank have been left with billions of dollars in unrealized losses on their books as a result of rising rates in March, which caused those government securities to be worth less than freshly issued bonds. The tech companies that were Silicon Valley Bank's biggest customers were also hurt by the higher rates. The bank started selling its damaged government bonds at a loss to repay the customers' withdrawals. Last month, the bank's chief financial officer, Daniel Beck, informed shareholders that Silicon Valley Bank would gain from the Fed's decision to stop raising interest rates. He said, "I believe it's going to be good for us to the degree that the Fed begins to move, and you start to see a fall in rates." But the bank could not outlast the Fed. A little more than 3 weeks later, it failed. Silicon Valley Bank said on 8 March that the sale of U.S. Treasuries and mortgage-backed securities resulted in a loss of $1.8 billion. As management announced plans to raise more capital, customers withdrew $42 billion in deposits on March 9, creating a run on the bank, as California state authorities put it. As a result, the once thriving Silicon Valley Bank had a negative cash balance of $958 million as of the end of the business. Clotilde Hewlett, California's Commissioner of Financial Protection and Innovation, in an order issued on March 10 said, "The precipitous deposit withdrawal has caused the bank to be incapable of paying its obligations as they come due, and the bank is now insolvent." That's all for today, guys. If you liked this video, be sure to leave a thumbs up, subscribe to the channel, and press the bell icon for any new updates. See you in the next one.